Two fantastic tax planning strategies connected to your charitable giving go head to head in this real life financial planning scenario. Which one wins? Got that and more coming up. Later in retirement, if you've got a lot of pre-tax dollars in a traditional IRA because you've been contributing to your 401k throughout your entire career, maybe you had some dollars that you saved into pre-tax dollars before the Roth was available, that sort of thing. You've got a lot of money saved up pre-tax, okay? And you also have some dollars sitting in a non-retirement account that have a lot of capital gains. Maybe you received an inheritance from your folks. They were not retirement dollars. They're not now sitting in a non-qualified or a non-retirement account, and there's a lot of capital gains. When you've got both of those and you're charitable, you're giving to the church or maybe giving to 501c3 organizations that you care about, well, which pile does it make sense to donate from? Should you do qualified charitable distributions, or should you donate the appreciated stock through using a donor advised fund? Two fantastic strategies, and we were facing this exact scenario with a friend of the firm just recently. All right, so before we dive into it, what are those strategies and how do they work? What are the advantages? What are the disadvantages? The qualified charitable distribution. Qualified charitable distribution. This is where you transfer dollars directly from your IRA directly to the qualifying or eligible 501c3 charity. You do not collect the dollars yourself, have them land in your checking account, and then donate them. You donate it directly from your IRA, directly to the church, directly to the charity. When you do that, the dollars that come out of your IRA and go directly to the church, they do not land on your tax return. You don't need to worry about, well, am I getting the tax deduction? It's just not taxable to you at all, period, which is fantastic. And that is the major benefit of the qualifying charitable distribution. It doesn't land on your return, therefore it is not taxable. Avoids federal tax and avoids state tax. It also can count towards your required minimum distribution that satisfies the RMD. That's the huge advantage of the qualified charitable distribution. The negative, you can only do it once you turn age 70 and a half or after. It's 70 and a half. I know a lot of folks that are saving up dollars and have them in their pre-tax account, and at 65 or 66, maybe in retirement, they want to do this. You got to wait until 70 and a half. Another maybe drawback is it can only happen from IRAs. It cannot happen from a 401k. Most people roll over their 401k to an IRA when they retire, but that's the limitation. Qualified charitable distribution, a very underutilized tax strategy, not to get a tax benefit on your giving, but just so that your giving isn't taxable to you. Qualified charitable distribution. The other one, donor advised fund, and specifically donor advised fund of appreciated stock. So a donor advised fund is an investment account that you pop up, that you open up, that basically becomes a mini foundation for you, where you have influence over it. You make donations into this foundation, into this donor advised fund, and when you make a donation, it's in that year that it counts as a charitable deduction, a charitable donation. Therefore, you get to add that on your taxes for that year, the year that you put the money in the donor advised fund, you add it to that year's taxes as a charitable donation. So if you itemize, then it's getting deducted right there on your Schedule A. But then this is the main benefit of the donor advised fund. You then have influence and control over when those dollars are released from your donor advised fund, from your foundation to the end charity. So if you are doing a bunching strategy, or you've got a very taxable, a high tax year because you received some sort of payout, sold a business, sold a property, something like that. So you have a uniquely high tax year, and you want to get a big write-off, a big deduction on your Schedule A, on your itemized deduction, you can make an outsized, a very large one-time donation into your donor advised fund, but then release the dollars still off to the charity or the church over several years out there in the future. So a lot of benefits with the donor advised fund, one of them being you control the timing of distributions. The other one is that you can invest the dollars within the donor advised fund, and you've got a lot of flexibility with it as well. It's not very often where these two strategies go head to head, Because again, qualified charitable donation, you got to be age 70 and a half, and donor advised fund, you can do at any time. But we had a situation just recently where they in fact were going head to head. The situation was this individual has a lot of dollars saved up in their pre-tax IRA, close to $2 million. They've saved up aggressively and over their entire career had dollars going in pre-tax, were getting company match and so on. It's about $2 million, and they're over age 70 and a half. They're not yet to required minimum distribution, but they're just turning age 70 and a half. So this is going to be a big required minimum distribution in just a couple of years when that hits. So big pre-tax account, but also a significant amount of non-retirement dollars that had a lot of appreciation. Some individual stocks that they had owned and also inherited where the cost basis, if you will, was right here, but the value of the account was way up here, and therefore both strategies were in play. Should we be doing qualified charitable distributions from the IRA, or do we donate some of the shares of the highly appreciated stock into the donor advised fund all at once so that we get a really big itemized deduction for that 1 year? Now, it depends on your individual, unique financial situation, but there are 5 very clear reasons where there's an advantage in this scenario, where there's an advantage to doing the qualified charitable distribution. The problem is, I think the individual really wanted to do the donor advised fund. That had some appeal to them, but there's 5 reasons. Not that we're, trying to, which one wins, and we like one idea, we don't like the other. They're both fantastic ideas, but looking at it objectively from a tax planning and overall comprehensive financial planning standpoint, there's 5 clear reasons why the qualified charitable distribution directly from the IRA is going to be more advantageous. The first is that doing a qualified charitable distribution directly from the IRA avoids federal tax as well as state tax. So you're getting a double tax benefit there versus if you do the donor advised fund of the appreciated stock, where you're getting a deduction on your federal tax return, but not a deduction on the state tax return. So the advantage, qualified charitable distribution. The other is if you do a qualified charitable distribution, and that means the highly appreciated stock at some point you're going to need to sell. Well, when you sell it, it's going to be taxed at capital gains rates, which are going to be lower than ordinary income tax rates. They have been traditionally, unlikely to see that change in the future tax codes. Right now, if you are in the tax brackets, the ordinary income tax brackets of 10% or 12%, then your capital gains are actually taxed at 0%. If you're above those ordinary income tax rates and you're in the 22, 24% tax bracket or up to a certain threshold, then your capital gains are at 15%. So there's always a slight advantage, a little bit lower tax on your capital gains. Therefore, using your IRA to make the charitable donations via the qualified charitable distribution, even if that means, well, you've got to sell the appreciated assets in the non-retirement account at some point, it's going to be less taxing than the opposite. And the third reason is, say you don't sell them, right? Say you don't sell the highly appreciated stock and you end up passing away with those dollars. They're going to receive a step up in cost basis, meaning no one's going to have to pay the tax on those capital gains. When your heirs receive it, they will then receive it at a cost basis of whatever the market value is when you pass away. That's not how the IRA works. When you withdraw dollars, you're paying the tax, and if you pass away and leave those dollars to your heirs, when they withdraw them, they're going to be paying the tax. So therefore, using the IRA to make your qualified charitable distribution, your charitable donations, that keeps those non-IRA dollars intact and will eventually get a step up in cost basis if you still hold those assets when you pass away. 2 more reasons why it's an advantage to do the qualified charitable distribution, and this 4th one is the new charitable deduction floor for itemizers. That's right. Starting in 2026, if you itemize your deduction and you are making charitable contributions, you only get to deduct on your Schedule A what is above 0.5% of your adjusted gross income. You only get to deduct what's above 0.5% over your adjusted gross income. Therefore, doing the donor advised fund, yes, it's still going to help you to itemize your taxes and you're going to get a deduction, but you're not going to get the full deduction like you have in the past. You now have to exceed a threshold. The first chunk, whatever that formula is for you, isn't going to be eligible for a deduction on your Schedule A. And then finally, Without doing the donor advised fund, this individual, their itemized deductions were only going to be about 10 grand. Therefore, their standard deduction was going to be about $25,000 above what they were going to have otherwise for Schedule A before doing this donor advised fund. Meaning, if they donate some of this highly appreciated stock, the first $25,000 isn't actually going to help them. The first $25,000 will make it so that they reach that threshold where, okay, well, now they'll itemize, but it actually doesn't improve their deduction. So if they donate 50 grand of the appreciated stock to the donor advised fund, the first 25 grand will make it to that they'll itemize, and then the next 25 grand will actually help them on their taxes versus a $50,000, not recommending that, but a $50,000 qualified charitable distribution coming out of the IRA going directly to the charity. None of that 50 grand is taxable, meaning all of it is going to create a benefit for them. So very unique situation that these two fantastic tax planning strategies go head to head, the qualified charitable distribution or the donor advised fund. Guys, they don't need to go head to head. For many people, it is, well, which of these makes the most sense for your situation? Pick the one that is best fit for you, looking at all 6 areas of your financial life, as well as your giving goals and some of your financial goals. Work with your certified financial planner to figure out which of those strategies makes the most sense for you. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.